Any other answers? Quick differences between Nifty and Sensex. How are they different and why are they different? Perfect. Okay. 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 Got it. More or less very well written. I like this answer by Mr. Swaroop. It says Nifty and Sensex are benchmark indices for measuring the overall performance of stock market. Nifty is the index used by National Stock Exchange, and Sensex is the index used by Bombay Stock Exchange. Very clearly and comprehensively written. Okay, so a great applause. Let's move to Nifty and Sensex. So, like I said, there are typically two stock exchanges which are very widely used. One is NSE, its index is Nifty. Okay, there are typically, let's say, more than 4,000 companies listed on NSE. Okay, but what does Nifty represent? It is a representation of 50 companies which are sectoral leaders, which are sector leaders, or which represent that specific sector or that represents an economy in a fair manner. Okay, so there are more than 4,000 companies which are listed on NSE. Now, if all those 4,000 companies function in a very different manner, it is not going to reflect how the economy is functioning. Correct? So, the idea of an index is to represent how that specific sector or how that specific index is functioning, and based on that, we judge whether that economy is doing very well or not. Okay. So Nifty, which is a representation of 50 companies from various sectors, which may be IT, which may be FMCG, which may be banks, which may be so and so, which may be pharmaceuticals. Okay. So these companies combined together form Nifty 50, which is 50 stocks in that index. And as these companies grow or these companies prosper or these companies go down, the index also goes along with them. So which is representing how the companies, the top leaders of those sectors are doing, and accordingly Nifty 50 is also moving along with it. Similar is the case of Sensex. BSE has an index by the name of Sensex, which is sensitivity index. Okay, which is represented by 30 companies, which is similar to NSE's 50 companies. Okay, there may be a variation in 20 companies. There may be certain companies which are included in NSE. There are certain companies which may be included in BSE. Okay, it does the same function as what Nifty 50 does. It represents sectors for the economy, and as these companies grow, these 50 companies or 30 companies grow, the NSE index Nifty 50 will also grow. Okay, a simple example. Let's just open up a chart of NSE. So let's take a very wide horizon. I'm just opening a chart on a software by the name of TradingView. I'll share all the links together with you all so that you can access all these tools for free. There is no charge to using this tool. Okay, so let's take an example of Nifty 50. This is a Nifty 50 chart that we have opened. A few years back, 20 years back, Nifty was trading at around 1,500 levels. Okay, what does that represent? The company had a base index of the companies which were comprised in the Nifty 50 had a base index of 1,500. So as the companies did well, as the companies grew, as the companies started to flourish, the Nifty 50 also flourished along with it. So as you see here, by the year 2008, which was a boom, uh, a lot of stock valuations had gone to a roof high. That is seen here. But because of the 2008 subprime crisis that happened in US by way of defaults, the market crashed. and that crash is reflected by way of company stock prices also going down, and along with that index also falling down. Now there may be certain companies which really did well during this period also, 2008 to 2009. There may be certain companies which really did well, much better than the Nifty index or much better than the Sensex index. But this index represents only those 50 stocks or 30 stocks which did well or did not do well. So because that one stock which outperformed the market exponentially, in spite of that, index may fall because this is representation of just those 50 stocks or those 30 stocks. Okay, as we progress, there is an upcycle that is happening. There is good growth that is happening. We can see by way of index which is moving up. By the year 2020, we were at peak. As COVID happened, a lot of companies were affected. These companies, because they were affected, their businesses were affected, their earnings potential was affected, their growth was affected. They started falling down. As those 50 or as those 30 companies started falling down, the index also fell down. But which was again recovered again on hopes that okay, there is not going to be much impact or a long outstanding impact on the market, and that is how index also started going up. Okay, so this is typically how the index or a cycle functions. Okay, so let's take a simple example of how the cycle functions. What is it? What is it that people look at? What is it when people invest? What is it when people get out of the market? And how does the cycle function? Okay, so we typically call that as an investment cycle or an economic cycle. Okay, so it typically has four legs to it, or it typically looks somewhat like this. It starts, goes down, goes up, goes down. Okay, so this peak we typically call it as a boom phase, where everything is doing very well, and the prices are rock high, and there is nothing, no fear, or there is greed which takes over. So it is at this period where everything is doing very well. There is no risk that people see. Okay, which may typically be a peak. There will be a period which is very rough, where there is no uncertainty, there is no certainty. There may be a lot of economic hurdles. There may be a lot of problems such as COVID. Okay, so this is seen here. It is this period where there is a lot of uncertainty, there is a lot of hurdle to growth, there is a lot of problem in the economy, which is reflected by way of a fall or a downfall. Okay, we call that as depression, or we call that as decline. Then there is this period where, which is the lowest, after which you see a typical rise happening. So this is the rock bottom that the market has gone. Okay, that we call that as trough, or that may be a rock bottom that we typically consider. And there is always after this, for a solid market, after a decline and after a solid rock bottom, for a good market and a stable market, there will always be a growth. Now this growth is typically a period which comes in after a decline. Okay, this again brings in people to the market, this again brings in money in the market. Because uncertainty is gone, this period is the growth period, is again where people start investing in businesses. They start doing businesses. They would not mind investing into risky assets. Okay, so this is how a typical economic cycle look like, which has typically four phases to it. One is the peak, another is a decline, there is a trough which is a bottom, and there is a growth phase. Okay, this can be seen in the market. 2008 was a peak, that 2007 was a peak, 2008 there was a crash, this was the bottom, and again after the bottom was hit, again there was growth, there was stability, again there was growth, there was stability, there was again growth. here again this was a second incident after the 2008, which was a larger crash. So this is how the market functions. It does not typically function in a very straight fashion manner where the market is just going to go up. There is never going to be a period where the market straight goes up. Why? Because there will be people who will want to exit, there will be people who will want to enter, and this entry and exit is typically what creates these waves. Okay, so that is a prime function, or that is a prime uh, characteristic of a market cycle. Okay, so far so good. Are we all together on the same page? Great. Any questions so far? I'm just taking a 1 minute breather. I just don't want this to be monotonous. I just want to take a 1 minute breather. Want you all to just relax, think about what needs to be answered, or any questions that come up to your mind. Okay. Um, I think we are good to go. Great. Okay. Yes. All right. So as we saw, there are multiple exchanges that uh, there are multiple exchanges in function BSE and NSE typically for us, and there are various other companies which are listed in those companies. Okay, so those companies, like we identified, there are 50 companies which are involved in the Nifty 50 index. So those may be from IT, those may be from pharma, those may be from banking, those may be from some other manufacturing. So these are typically sectors which we are talking about. Correct. So these sectors may also have their own index. Like Nifty 50 is a large father index. There may be a child index involved, which may be an IT index, which may be a banking index, which may be a pharma index. Correct. So we'll see what that index looks like, or what those index companies comprise of. Okay. So we are going to NSE India website, nseindia.com. I'm just sharing the link with you all together. Okay. Under NSA India, we are just going to go to market data and equity and SME market. Or let's go to indices. Okay. Market data and indices. So under indices, you see Nifty 50, which is, I'm just zooming in. Can you all see the screen properly, or do I need to zoom in more? Can you see the screen? Just mention screen. Type in screen in the chat. You can see the screen. Perfect. You can see the screen. Okay, so here what we have opened, what we are opening is a broader market index. Okay, so which is under the Nifty 50. Okay, so Nifty 50 is the father index which a lot of people follow. There may be certain other companies which are not included in Nifty 50. So there may be Nifty 100, there may be Nifty 200, which is top 100 or top 200 sector representations. There may be Nifty mid cap, there may be Nifty small cap. Okay, there may be other indices which represent a various a different sector for that company, which is a sector specific. So Nifty Bank represents all the banking companies which are part of that. There may be Nifty Auto, which has all auto companies listed under that. Okay, so let's open Nifty Auto for the sake of understanding it. Okay, so I just opened Nifty Auto. I just clicked on Nifty Auto under the sectoral indices, and there is Nifty Auto which is coming up in front of me. Okay, so these are all companies which are auto manufacturers, or those may be auto ancillaries. So let's say MRF, which manufactures auto tires. There may be Amaraja Batteries, which manufactures batteries for auto industries. There may be Hero Motocorp, which manufactures bikes. There may be Exide Industry, again battery manufacturer. So similarly, there are a lot of companies which represent the auto index or the auto industry, and therefore are comprised under Nifty Auto. There may be similar to Nifty 50. There may be a lot of companies which are not included in Nifty Auto, just because they are not sector representatives. So this is how you will understand what a sector comprises of. So the data is quite commonly available. You just click on Nifty Bank, you will see a lot of representations from Nifty Bank. And if you want to see whether any specific stock in the Nifty Bank is actually performing well or not, you can just simply see it in a glance here. Okay, so like we identified, there are indices, which is Nifty 50, which is a broader index, and there may be a sectoral index, which is typically an IT index or an auto index or a banking index. Okay, so the cycle for investment cycle may not necessarily be same for all companies together. Correct? Can someone give me an example of why it will not be same for all companies together? Why there may be a peak in one industry and a decline in another? There may be a growth in another and a trough in another. Quickly in the comment section, why economic cycles may be different for different sectors at the same point in time. Okay, Dwanit says demand and supply could be one factor. Mitesh is saying, like in COVID times, pharma was at peak and hotel industry and tourism was down. Perfect, Mitesh. Any other thoughts? Mitesh has brought out a very interesting point. So he says in COVID times, pharma was doing very well, hotel industry and tourism was down. But now, if you see, pharma is actually not doing well because the uncertainty related to medicines and the supply of pharma products has also gone down. Okay, so we have to always understand what that specific industry is doing at what point in time. Okay, so that is what differentiates a good investor and a bad investor. A good investor is typically always investing in this phase, a growth phase. A bad investor typically invests in a peak or a boom phase, where valuations are drastically high. They may invest in this, and if there is a downfall, he will face a loss. Now he takes that loss and says, "Market is very bad. It uh, causes losses. There is unlimited loss for you." That all happens. Now, to avoid this economic cycle, because it is not the same for all industries together at one point in time, we diversify. Okay, so that is how diversification comes into play. What do you mean by diversifying? Let's say you have 10,000 rupees in your kitty. You invest 2,000 into banks or banking companies. Let's say you invest 3,000 into auto, and let's say you think IT is going to be the future. IT is going to bring in a lot of opportunities of growth. Let's say 5,000 you invest in IT. So let's say there is a uh, burst or there is a depression happening in the banking sector. IT may typically go higher. Or let's say there is IT which is being affected at present, which is the case right now. A lot of US companies uh, have gone down on valuations. So a lot of stock prices crash has happened. Facebook, which is now known as Meta, has also fallen down in price drastically. You talk about Netflix, a lot of subscribers have gone out, which has caused loss of revenue for the company, because of which the stock prices have gone down. So if you do not want to fall under one specific crash or one specific industry, and which does not directly or substantially affect you, you can consider diversifying. So some investments into banking, some investments in autos, some investments in IT. Now do not over diversify also, because if you over diversify, a return of one, let's say IT is doing substantially well, but you have invested in five different sectors altogether. Those five different sectors are actually not going to give you substantial growth, right? So you have to identify what growth cycle we are in right now for that specific industry, and how the growth is going to happen. So that is why a lot of people focus on growth and understanding what growth is. Okay. um, Moving ahead, since we are talking about the factor of growth, uh, there is this commonly used term which we refer to as GDP. Can quickly someone tell me what GDP is? Okay. Dwanit says it is gross domestic product. That is amazing. Fantastic. So what typically gross domestic product is? It is a term which economists or financial forecasters or investors use to represent what the company is producing and growing at. It typically represents growth in the company. Okay. So when we talk about growth, how will growth happen? Okay, growth will happen when, let's say, there are certain funds in the economy, or let's say there are funds with investors. They lend it to companies like B Limited. B Limited manufactures something. So when they are manufacturing, they will import machinery or purchase machinery. They will spend that money there, or they may invest in raw materials, and similarly something which helps with manufacturing for B Limited. When they manufacture it, they sell it to a consumer who typically pays for that product, and that consumer again brings it funds to the company. So it is a cycle. This is a economic cycle or a growth cycle that is on a continuous basis. So far as this cycle is functioning, we call it, this is growth. This is uh, this cycle typically represents this point in the economy, the growth that is happening. More funds come in, more manufacturing happens, more products are being manufactured, more consumers purchase it. As more consumers purchase it, more money flows back in the economy, and therefore the growth happens. As opposed to that, if there is no fund in the economy, the cycle is going to reverse in a different manner. There is going to be a halt in manufacturing, there will be a halt in purchase of machinery, there will be a halt in setting up factories, there may be a halt in producing certain new products or risky products. So that is how the cycle will stop functioning. Okay, so that is where we call as GDP is not growing well in that case. So in that case, where the cycle is stop functioning, we say GDP is going down. When the cycle is functioning very well, we call it as GDP is going up. Okay, that is typically growth that is coming in the business, that growth that is coming in the economy. Okay, at a broader level, what affects GDP are two main institutions or two main deciding factors in the economy. Okay, how GDP is affected it is affected by way of government actions and by way of Reserve Bank of India. Okay. Now, how does Reserve Bank also participate in the GDP, or how does government actually affect GDP? Okay, can someone quickly answer why is Reserve Bank of India required? I mean, the government is there. The government is going to spend money. Government is going to collect taxes. The government is going to build projects. The government is going to build uh, bridges. The government is going to build manufacturing facilities. The government is going to build roads. Then why do you need Reserve Bank of India? Quickly, can someone tell me why Reserve Bank of India, or how Reserve Bank of India also participates in the GDP growth or decline? It has been trending in the news currently how Reserve Bank actions are going to affect GDP, or what is happening in the US currently. In the comment sections, please. Perfect. Dwani, that is an absolute fantastic answer. Dwani says to control currency and liquidity. Any other answers? That is definitely one factor that the Reserve Bank of India controls. That is currency and liquidity in the system. Any other factors or any other answers how Reserve Bank of India actually affects it? Or maybe Dwanit, if you can throw some light in terms of how liquidity and currency is being controlled by Reserve Bank. Okay, I think I'll throw some light on that topic. As regulator, okay, RBI acts as a regulator. Perfect, that is true. Okay, let's bring Mitesh. I'm just trying to explain from the GDP perspective. RBI is definitely a regulator. Similar to RBI, there is an insurance regulator. There is a stock market regulator, which is SEBI. There may be certain other pollution control boards, which are regulators for pollution control. But here we are talking about how RBI is going to affect the GDP. Okay. So let's break it down further under what actions of government GDP is going to be affected, and what actions of RBI the GDP is going to be affected. Let's take a simple example of government. Let's say government uh, starts building infra projects. Okay, so when the government starts building infra projects, at that time for building those bridge, or to build those construct or highways, or to build those storage facilities or manufacturing facilities or ports, government is spending some money. When the government is spending money, it is being paid to some contractor or some businesses. Now when those contractors are actually uh, being paid, they are actually going to be spending it on employees, or those employees, or building new facilities, building new companies, starting new projects. Now they start earning money. When they start earning money, they start spending. Now employees being paid, they start spending on FMCG products. They may start buying some uh, apart from their essential products. They may start buying consumables. They may start buying a car. They may start buying automobiles. That is how the GDP is going to grow. As the government spends, the GDP is going to grow. As opposed to that, let's say the government has halted this completely. It is not doing anything of the build phase. It is not going to spend. Since it is not going to spend, there is no income for the other companies which are operating in that business. Because there is no income, they will not hire. They will not hire. They will not. Employees will not have money. They will not spend again. So this is a reverse cycle of how the GDP is affected. Now, what Reserve Bank of India does is silently monitors inflation, and as it monitors the inflation, it decides how much money should be flowing in the economy or no. So it will monitor the money flow in the economy and the money flow out of the economy. That is by way of, let's say, rising interest rates. If it increases the interest rate, Reserve Bank increases the interest rates, the borrowing is going to be expensive. And because the borrowing is expensive, a lot of less people will borrow it. A lot of less people will borrow it. A lot of less infra facilities will be built. A lot of less infra facilities being built. A lesser GDP or a lesser growth is happening. As opposed to that, when the interest rates are actually falling or being reduced, the money, uh, a lot of money comes in the system. A lot of money comes in the system. A lot of growth happens. A lot of building happens, and that is finally how GDP is affected. So these are the two key instruments or two key elements: the government and the Reserve Bank of India, which affects the GDP. Okay, right, Mitesh. Interest rates are some factor which kind of affects the money flow also. Uh, Demonetization is a completely different activity that happened. That is not a day-to-day business of the government or the Reserve Bank of India. So the demonetization was actually announced by the government, but it was being uh, done in coordination with the Reserve Bank of India. So it is not an act which typically affects the GDP by itself. Dwanit, are you able to hear me? Okay, you are able to hear. Perfect. ठीक है. Okay, so demonetization was one activity that happened out of a different cause. It was being done for a different cause. Ideally, that is what is being claimed by the government, that there was a lot of black money or a parallel economy. To just take that system out, it was being done. Some claim that because demonetization happened, a lot of money which was in the uh, hands of people or which was not in the banks was actually being brought in the economy by way of deposits. So that is how the economic growth also happened, which was indirect. It is not a direct form or a regular day-to-day business for the government or Reserve Bank to increase the GDP. Okay. Um, Now let's take a quick poll on how many of you already have invested, or how many of you know what equity investment looks like, or how to go about it. Okay, so I've just made a quick poll of whether you know investing, whether you know how equity investments is to be done, whether or whether you do not know how investments are done. Okay, two votes coming in. Okay. Okay, those who are already investing, apart from equity shares, are those any other investments that you are making apart from equity shares? Are you all also making some other investments in some other assets? Gold is one asset, correct? Any other investments that you are making? Property is one investment, yes. That is typically a real estate that you invest in. Correct. So more or less, we invest in equity, we invest in gold, we invest in property. Okay. So when you're talking about investments, there is also a need to understand what kind of investment suits you. Okay. So if let's say you want a safe investment, a very secure investment, an investment where let's say you invest in that asset and you need money tomorrow, there should be no loss while when you sell it. So gold is one such investment where you get a very quick, easy price out of selling it. Property is one investment where typically you invest in a property, you don't expect to sell it like an equity share, where you invest in a property, you exit, you invest again, you exit. Correct? So there are complexities, you do not necessarily get liquidity in the investment. Similar to that, equity shares also have their own pros and cons, which are similar to gold and which is similar to property investment. Okay, I'm just ending the poll right now. So, what are the pros and cons of equity investment? Okay, so let's talk about equity investments. One is liquidity that you look at. Let's say you invest today and you want to sell it tomorrow, whether you're going to get that. Okay, so liquidity is one factor that we consider when we are investing in equity. Normally, for for investments in equity shares, we typically keep a horizon which is more than 1 year, 2 year from an investment perspective. Unless you are a trader, for a trader, you may just buy it today, sell it tomorrow, or buy it today and sell it today itself. But from an investment perspective, where you want to secure your money for a longer period of time, the horizon for equity is typically 1 year, 2 year, and above. It is said when you're investing in equity shares, you would typically want to keep a period of 7 to 8 years in your hand for a longer wealth creation, longer term wealth creation. So liquidity is one factor that you need to consider. There may not necessarily be liquidity available to you. For example, let's take an example of the chart again. We are talking about this period. I'm moving the chart pattern to 1 day. This one candle represents a day in the market. Okay, so let's say I started investing on first of or third of Jan as a New Year's resolution. I started investing here. Let's say I invested in a company for 17,000 rupees, 17,500 rupees. I keep invested in the company. The value goes up. It went to 18,000. It went to 18,200. Now, if I do not sell it and it falls down, it has gone to below 17,000. Okay, it is up to here. So where I invested at 17,500 and now it is less than 17,000 also. So when you are investing in equity, you need to know if there is a downfall, whether you will be able to hold it for that period of time. And then once it goes back up again, then you may sell it at a later period. So that is what you will need to understand. You will need to assess and think of investing only that sum in the equity investments which you are able to afford to hold it for a longer period of time. That is the objective of equity. Unlike a debt, let's say you invest in a debentures of a company or you invest in a fixed deposit, you know that the period of investment is very fixed, which is 1 year or 2 year or it may be 5 years. So when you're investing for such a short period of time, you need not worry about the fluctuations in the equity market. Your investment is anyways going to be returned to you after the end of that period and which is not going to affect you. Correct? So it depends on the fund allocation where you need funds after a 1 year period in time. You do not know where the markets will be after 1 year. Rather not invest those funds in the equity at that point in time. You invest in debt, and once you uh, the period of or the tenure of investment is over, you exit or withdraw those funds. So that is how you need to allocate your funds based on the timeline. So one factor that we need to consider when we are making equity investments is liquidity. Second is you talk about uh, risk. For a debt, the risk is very low, where at the end of the tenure you are anyways going to get your money back. Versus for equity, if the company goes bad, the company is crashing down, your investments in equity will also crash down. So the risk is also high, but the reward is also good. If the company does well, your investment value also goes up according to that. So you need to also factor in how much risk are you willing to take and accordingly invest. Okay, so now this risk and liquidity also depend on a very commonly categorized function of stock market or of the equity market, which is market capitalization. Okay, so we broadly categorize these companies into three categories. One is very large companies, one is medium company or we call that mid cap, and one is smaller companies which we call it small cap. So at a broader level, we categorize the market into three categories based on the size of the company. So if it is a very large company, I will call it as large cap. If it is a small company, I'll call it as if it is a medium sized company, I'll call it as a mid cap. And if it is a smaller company, I'll call it as a small cap company. So a lot of mutual funds, a lot of investment companies, when you are making an investment, you typically come across these terms. This is what it represents. Can someone quickly give an example of a large cap company? A quick example of a large cap company. Tata, okay. Tata has multiple companies in it. So let's say Tata Motors is one of those. Tata Properties, Tata Investments would be one of those. Tata Steel will be one of those. Tata has a IT division which is Tata Consulting, Consultancy Services (TCS), which is one into IT companies. Any other examples of large companies? Okay. Uh, Geo. Okay. Geo Dwanit actually falls under Reliance Industries Limited. Reliance share. Geo is not specifically a listed company. So Reliance owns shares in the Geo entity, and that is how Geo is different. Perfect. Wipro is one such IT company which is a large cap. Reliance is a large cap. Yes, correct. Any examples of mid cap? Okay, my sister is saying Larsen and Tobro, which is one of my favorite companies. Any mid cap companies? Okay, let's talk about small cap companies. Do you remember small cap names? A company which has a market capitalization which is very small as compared to a large cap or a blue chip. Okay, you may take some time to think, understand whether it is a small cap or a large cap. In the meanwhile, I am just opening up something else. Okay, so apparently we do not remember which companies actually fall under mid cap or actually which companies fall under small cap. So this work is being made easy for us by NSE. If you go to NSE website, I'm just sharing the link with you. and click on any of the sectoral indices. Under sectoral indices, if you click on any of these small caps or mid caps, you will actually see those small cap companies. So if you want to invest in a small cap company, you do not know where to find those, you can find it here. Okay, so under indices, under market watch indices, you can see a lot of mid cap, small cap, mid 50, mid 100, small 50, small 250, small 400, and accordingly find good stocks from there and invest. Okay, so this indices actually help us also identify what companies are being found under that index. So if you do not know the name specifically, let's say you know Larsen Toubro, you know Reliance, you know Wipro, all these companies names we anyways know because those are very famous companies, very large companies. But if you do not know small company names, you can simply find it from here. And accordingly do your research, do your investment diligence, and then make an investment. Okay, now a very quick and interesting. Okay, thank you. I think people are following it. Now a very quick poll and a very interesting poll that we are going to do right now. Okay, so which of the following is a small cap company and which is a large cap company? Okay, based on the price. Okay, I'm just giving the prices below. Uh, one company which is A, which has a price of rupees 50, and one company which is B, which has a price of rupees 100. Okay, which is a small and a large. So let's take for a simplicity case just a small cap company. Which amongst these two is actually a small cap company? There is one share which is worth rupees 50, and there is one share which is worth rupees 100. Which among the two is a small cap company? Which among the two is a large cap company? So if you can just identify a small cap company amongst these two. The poll is live. You can just vote which company you would want to go with as a small cap company. Okay, in the comment section, if you can just mention, okay, this is not the right criteria, and what is your reasoning behind that? In the comment section, in the meanwhile, you can type in that. So there is one company which is A Limited, whose share price is rupees 50, and there is another company B Limited whose share price is rupees 100. So which of these two is a small cap company? If you can identify that, you can just start voting. And if you cannot identify just based on that, you can just mention it under your doubts. Okay, I'm getting very interesting answers. So it depends on the market capitalization. Just the share price does not determine whether it is a small company or a large company. Okay. So like my sister clearly identified, it depends on market capitalization. Dwanit is identifying it could be either. The share price doesn't seem to have relevance here. Correct. So it is absolutely right. Just because a share price is 50 rupee, it does not necessarily mean it is a small cap company. Okay, and just because the share price is 100 rupees, it did not necessarily mean it is a large cap company. We'll take a quick simple example on the board right now. Okay, so let's say A Limited, its share price is worth rupees 50. That is one share price. And B Limited, which has a share price of rupees 100 for one share. These are share prices per share, 50 rupee and 100 rupees. Now, whether that company is a large cap company or a mid cap company or a small cap company, it is categorized based on the total market capitalization, not just based on the individual shares. Let's say A Limited has 100 shares listed and B Limited has uh, 2 shares listed or 10 shares listed, or let's take a simple example of 10 shares listed. The total market capitalization for A Limited is the share price per share multiplied by the number of shares, which is going to be 5,000 rupees here, versus B Limited has a 100 rupees share price and 10 shares listed on the exchange. Its market capitalization is just 1,000 rupees. So even though the share price of B Limited is higher, the market capitalization is actually lower. And the share price of A Limited is lower, the market capitalization is actually higher. So the market capitalization is what determines whether it is going to be a large cap or a small cap or a mid cap company. Correct? So it completely depends on the market capitalization. Now you have to understand whether you would want to invest in a company which has a market capitalization of a good sizable sum, or you want to invest in a company which has a market capitalization which is a very low. Each of these have their own pros and cons. These companies are typically considered to be as safer investments, blue chip companies. Infosys, Reliance, L&T Limited, Wipro, or some other HDFC Bank, HDFC Limited. These are typically companies which have a good market capitalization and therefore are considered to be safer bets. But the returns that they give compared to a small cap or a mid cap may not necessarily be good. So these companies, though the market capitalization is less, but the growth potential for them may be very high. So that is why you need to have a right balance of investing in a small cap, mid cap, and a large cap. Okay. Um, so far, so good. I hope any doubts, any questions. Okay. So far, so good. Perfect. Now, what based on the market capitalization, there are mutual funds which actually categorize their mutual fund investments also. So MFs, that is mutual funds, will also be based on large cap, will also be based on mid cap, and will also be based on small cap. Now you may want to invest in large companies. Instead of buying shares of those companies, you may invest in a large cap mutual fund. If you want to invest in shares of medium sized companies, instead of investing directly in equity shares of medium sized companies, you may invest in a mutual fund which is a mid cap. Instead of investing in a smaller company directly as equity, you may invest in a mutual fund which is a small cap. Okay. So the categorization also depends, and accordingly you can invest. Now, as we clearly identified, you need to diversify. So just instead of equity investments, you may have in your portfolio equity plus MF, that is mutual funds, or you may have equity plus debt, you may have equity plus gold, or you may have a combination of any of these. Correct? So the diversification depends on completely on your risk appetite. Why we call this as a risk appetite? Because equity investments may be subject to a higher risk compared to debt investments. So you may want to have a proportion of 80% to equity and 20% to debt. Or you may, let's say, there is some aged person, let's say he wants to invest, his age is 65 years of age. He may simply not be able to afford a downside of equity. So let's say he will invest 20% in equity and 80% in debt. So that his investment is safe. At least the capital is being preserved. So that is what ideally investments look like, or diversification happens. Okay, so far so good. Any other questions apart from what we have been talking? Anything that you have in mind, or maybe you want to ask? Dwanit, do you want to ask something? Some specific question or something that you would want to understand? Okay, you want to understand the working of mutual funds? Okay, we'll do that. Any other questions, any other topics you want me to cover? We have half an hour left. I just want to take in more questions or more topics from you all so that we can cover those in that period. Okay. ठीक है, we'll take the working of mutual fund, how mutual fund functions and how is it different, or what actually happens in mutual fund investments. Okay. So just before that, this is what diversification look like for an equity or a debt or for a different asset class. So this typically we call that as asset classes. Equity is an asset class. Mutual fund is another asset class which may be into debt or which may be into equity. Gold is another asset class. Real estate is another asset class. So what we are building for our wealth by way of different assets, we diversify based on the asset class that suits you. Okay, let's move to mutual funds. How does mutual funds work and how is the system that happens? Let's say, Dwanit, you want to start investment. You have a monthly income of, let's say, 10,000 rupees. Okay. And now let's go to check the price of a share, which let's say SDFC. Okay. I'm taking you on the chart right now. Let's say I go to SDFC chart and it's priced at 2,441 rupees. Okay. SDFC Limited. Now let's say you have an income of 10,000 rupees per month and you want to invest and diversify into various sectors. Let's say HDFC being one, L&T being one, Reliance being one, SBI being one. The 10,000 rupees is going to be a very small amount for you to diversify and invest in individual equity shares accordingly. So what you will do is you will give this money to a mutual fund. Okay, the mutual fund will take that 10,000 rupees along with other investors. So Dwanit is investing 10,000. There may be Yogesh who is investing 7,000. There may be Mr. A who is investing 5,000. So what this mutual fund does is it takes the cumulative amount in a pool which is 22,000 rupees. Now this 22,000 rupees is being invested in HDFC, is being invested in L&T, is being invested in SBI, and is being invested in Reliance. So the mutual fund is doing a function of pooling of all those investments together, which come in from different people, and then accordingly invest in the theme of that mutual fund. So if the theme of the mutual fund is large cap, then it will invest only in those large cap companies, which is Reliance, HDFC, L&T, SBI. If the theme of the mutual fund is a small cap, then it will invest in smaller companies. But the function remains the same. It pulls in the money from different investors, which is Dwanit, Yogesh, Mr. A, and accordingly invest in different instruments of different companies. Now, what is the benefit of a mutual fund? You do not necessarily need to research on Reliance. You need not research on HDFC. Need not research on L&T specifically. But you trust the fund manager who is an expert, who knows economy, who knows and understands investing, and he does his own research, due diligence, and invests. So the time that you are required to invest on researching on different instruments, different companies, that goes down. That is reduced. So that is the function of what mutual fund does. And at the same time, you are going to earn a good return, which is relatively safer. Relatively, you do not need to put in that much time and effort, and still earn some money from the investments. So that is what typically you will get as an investor. Okay, so now these funds may be categorized under large, mid, and small. They may be funds which are investing only in debt. There may be certain other thematic funds. Okay, so if you okay, let's search for types of mutual funds. So it may not necessarily be based categorized based on uh, large cap, small cap, or mid cap necessarily. It may not necessarily be just debt, or it may not necessarily be just equity. There may be various other themes that they follow. Okay, so let's take an example of Tata Ethical Fund. Okay, it has returned 21% per year. Uh, so it may have its own theme. That theme may be functioning at this point in time, like based on the investment cycle that we identified. Let's say, um let's say IT is currently in boom, and IT stocks are going to go up. So the theme for that mutual fund for this specific period may be IT. Once that IT theme is gone, it may just close down the fund and move to another theme, which may be pharma, or which may be social good, or which may be economic good. So based on the theme that the mutual fund decides, you invest in that theme. You believe in that theme. Let's say exports and services. You feel exports and services are going to do well. Instead of just categorizing based on large cap, medium, or small cap, you bifurcate your investments into exports and services, which may be large, mid, and small by itself also. So the theme does that work. So Franklin India Opportunity Fund. So what does this fund do is typically invest in companies which are originating in India, and which have a growth potential as India grows, or based on the consumption story. L&T business cycle. This is typical to the economic cycle that we just saw. So it will invest in those companies which are in this growing phase, and accordingly exit as they see that okay, the peak has arrived. They will exit it. They may enter again at a very low or a bottom price for another industry. So themes is something that is categorizing a mutual fund investment also, apart from the large, mid, and small cap. Dwanit, are we getting it? Are we understanding it? Okay, great. Any other questions? Any other topics you would want to understand? Okay. Um, I think we will wrap it up then, based on what we have understood so far. So what we have understood is there are multiple exchanges. One is NSE, one is BSE, uh, which both of them are based out of. Okay, I'll answer that right. Could you explain the difference in the security for equity versus MF? What do you mean? I mean, security, are you talking about equity shares or debt that ways, or what is your question? Dwanit, I'm not understanding your question properly. Could you explain the difference in the security for equity versus MF? Are you talking from a risk perspective, or are you talking from a okay, safer? Okay, right. So not necessarily mutual funds will always be safe. Let's say I am some person who understands investing. I know how to scout out for good investments in equity. I may rather perform my own equity investment rather than a mutual fund. But a mutual fund is safer for beginners because they need not do their own due diligence. They need not invest their uh, time, which they may ideally be investing somewhere else. And mutual funds, because they have a network, they know, they have their own research teams, they understand markets better, they understand economic events better. Therefore, it is ideally considered to be safer. But it is not necessary that always mutual funds will be safe. There may be instances where you invest in a theme, the fund manager actually does not perform well, there may be losses. So it's a very common thumb rule that we say, instead of investing as a beginner directly in equity, invest in mutual funds. That is the idea. Because mutual funds know what they are doing, they know the market, they understand the market conditions, and accordingly invest. Does that answer your question, Arvind? Okay, perfect. Okay, so let's wrap the topic now. What we have understood so far is one. Okay, let's go and quickly wrap it up. Okay, so we've understood there are multiple exchanges functioning in India. One is NSC, another is BSC, which are commonly known as. We understood there are indices. Commonly followed indices are Nifty 50 and Sensex. We understood the importance of diversification. We understood asset classes. We understood a bit more about what mutual funds are and how do those function. We understood economic cycles, and we understood what else? Some nuances of how the stock market functions, or what are the features of a stock market. Okay, uh, I think we fairly covered it up. Anything else? One is GDP. How does GDP? How is GDP affected by the government? How is GDP affected by the RBI movement or actions? What are economic cycles? What is the prime difference between share and a debenture and a preference share? How is equity share different from a share? And the main four main functions of what the stock market are. One is capital provision, one is wealth generation, one is matching of finances, and one is economic uh, growth of the economy or a nation. I think we are here fairly done. Um, Apart from that, any other thing specifically on uh, how to buy and sell shares, or anything that you would want to know? Do you want me to explain to you how shares are being bought, how shares are being sold, or something like that? Or would you want to cover that topic? Okay. Apart from Dwanit, anybody, any other person who would want to know that function also? Okay. Mr. Arvind is asking how to buy gold ETFs. Okay, I'll answer that. Any other questions? Okay. Okay. Let's go to answer those questions. Before we actually buy something, we do our own research. Okay. I'm just going to touch upon this one topic which is very important for you to understand. How do you decide whether to buy it or not? Okay, one is fundamental analysis and one is technical analysis. In the subsequent sessions, I'm going to cover these two topics at length. Again, they are a different world in themselves altogether. So when we talk about fundamental analysis, we talk about common sense. Okay, it is common sense that okay, is the company going to grow? Is there growth opportunity for them? Is it going to be beneficial for the economy? Is it going to be something worth buying? Is it going to improve its profitability? So that is what we analyze in the fundamental analysis. Okay, before we buy a company, let's say I want to buy Reliance. Why will I buy Reliance shares? It is because if with the help of 5G network, it is going to grow well, it is going to get more users into its network, the company is going to do well. And if the company is doing well, the profit is going to go higher. And if the profit is going to go higher, the share price is going to go higher. That is why I will buy Reliance shares. That is what I will analyze under fundamental analysis. Under technical analysis, I check the charts. So here under charts, there are various chart patterns, there are various moving averages, there are various indicators that we follow. So a few commonly followed indicators, I may take one more session and explain to you all about those as well. So broadly, there is fundamental research and technical analysis that we do before buying or selling anything that we are doing in the stock market. Okay. So when Mr. Arvind is actually asking me a question, how to buy gold ETFs. So is there a rationale behind buying gold ETFs? Mr. Arvind, why do you want to buy gold ETFs? Mr. Arvind, I am asking, repeating the question again. So you say how to buy gold ETFs. So obviously you have something in mind that you would want to buy gold ETFs, correct? So when you are thinking about that point, what is that point because of which you would want to buy gold ETFs? Okay, I think I'm either not audible or okay, I'll probably answer it for him. So instead of buying physical gold, what is gold ETF? Gold ETF is actually a exchange traded fund, like a mutual fund. ETF is an exchange traded fund, like a mutual fund. Okay, it tracks the value of underlying, and accordingly the price also goes up or down based on the price of the asset that it is being tracking. Okay, so let's say in case of gold ETF, gold is the underlying. As the price of gold goes up, the price of this ETF will also go up. As the price of gold goes down, the price of this ETF will also go down. So Mr. Arvind is wanting to invest in a gold ETF. That is because he is thinking gold is a safer investment. It is not going to fall down drastically, and instead of buying physical gold, I can buy digital gold, which is in form of an ETF. So by buying those ETF units, it is as good as you are buying gold at that current price and keep on holding in a Demat form without worrying about it getting stolen, without worrying about storing gold, physical gold. Okay, so that is what gold ETF does. So there are multiple ETFs available in the market. You can straight away go to uh, the Demat account that you may be using. So I use Zerodha, Upstocks, and one more Profit Mart. So you may simply go there and search for a gold ETF. So Nippon has one good gold ETF. is not showing it here, but let's search for gold ETF. Gold Bees is one ETF by Nippon. There is Gold Share, which is again an ETF by UTI. There is Kotak Gold. There is SBI ETF Gold. So there are multiple mutual fund agencies or mutual fund houses which have their own ETFs created. So if I want to buy a gold ETF by Nippon, I will search for Gold Bees, or I can just simply search gold ETF and I'll find Nippon India ETF. So you simply go there. If you have funds in your account, simply click on buy and place an order. You will buy that ETF at the current price. So as the gold prices go up or go down, this price will go up or go down. It is as simple as buying an equity share. Okay, I hope that answers your question, Mr. Arvind. So there may be multiple ETFs, there may be multiple fund houses which have their own ETFs. So you check which fund house is charging the lowest fee, and it is more or less the same. The return is going to be more or less the same. Okay, Mr. Prasad is asking what is commodity market, money market, foreign exchange market. So, like equity is one instrument, there are multiple commodities. So, MCX is an exchange where commodity futures are being traded. Okay, so NSCP, what do we trade? NSCP, we trade uh, equity stock, equity may be traded, preference may be traded, and debt may be traded. But there is no commodity which is being traded on NSE because NSE is not meant for that. So there is a separate exchange by the name of MCX where gold and commodities are being traded. So they are typically called as precious metals and non-precious metals. Or there may be certain other commodities like udit dal. There may be certain commodities like silver. There may be dana dal, which is also traded. Chana is also traded. So these are all mainly used by farmers or producers or traders to hedge their positions. But people actually speculate, and they can also trade in these commodities. Okay, Forex market again, NSE has a currency derivative. So apart from equity, preference, and debt, it has currency segment, which is a separate segment under NSE. So you can trade currency also there. Uh, Forex money market. Money market is uh, unlike equity and debt, which is typically for a larger period of time that we are talking about. Money market is typically for a period which is less than 365 days. Okay, so this money market may be typically there are instruments or there are methods of trading which is call money market or notice money market, or there may be certain liquid instruments like uh, government securities or bonds, but these are for a period of less than 365 days or up to 365 days. Anything beyond 365 days is not technically called as money market. So if I want to buy a government security or a bond which is expiring in less than 365 days, it will fall under money market and I can trade in that. If it is more than 365 days, I will not categorize this as a money market instrument. Okay, Jiju, does that answer your question? Okay, perfect. Okay, I think it's time to wrap up. But before we wrap up, uh, I think fundamental and technical analysis is something which is a very vast topic in itself. Probably it takes more than 5 to 6 sessions at a sitting for either of the two. For fundamental itself, 6 to 7 sessions, and technical itself, 7 to 8 sessions may be required. So we will take up some more topics in the future and try and understand those also as we progress. So for now, I hope we have quite understood these topics. So is it okay if we wrap it up now? The session, I think we've fairly covered what we ought to cover. Okay, I'll just drop in my email address here, and in case if you have questions or you would want to get in touch, you can feel free and get in touch, and we'll get those doubts and queries resolved. I've shared my email address and mobile number. In case if you have queries, you would want to get your doubts solved, you can straight away drop me a WhatsApp or an email. And any help regarding opening up an account or anything that you need, I'll definitely be of help. Okay, perfect. I think I'll end this session right now then, unless there is any question or anything that I can help with. Yeah, Mr. Arvind, I've started recording the session midway. So from that period of time, I'll share the link with you all for recording. And also, if possible, I'll share the links, the various links that I've gone through and for Demats or anything that you may need under one PDF. I'll do that. All right. I think it's time to wrap up. We've wrapped up in the 2 hour session that we wanted to do. Any queries, any questions you want to get addressed, feel free to reach out. All right. Thanks a lot for taking your time, bringing. Yeah, thank you. Thank you. Pleasure to help you. Yes. All right. Thanks for your time. Thank you. Thank you for attending.